Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, today Mena and I would like to talk about the recent proposed taxation changes, the much discussed taxation changes that were included in May federal budget. Of course, everything is still proposed and there's a bit of horse trading going on, a lot of conversations and not much consultation. I think the consultation period was like 2 days, and the drafting of the legislation is starting to come out. Even that's a bit dodgy in terms of there's a lot of ministerial discretion in the law, which is kind of unusual and maybe tells us that a lot of these policies have been rushed and not necessarily well thought out. Having said all that, let's talk about some of the things that we're thinking about in terms of helping small business clients kind of navigate some of these changes. And I think by talking about it and talking about potential solutions, I think it helps us understand to what extent will these changes affect individuals, because on the face of it, these changes look pretty ordinary, but I think for many people listening to this podcast, I think the practicality of the changes in their situation will be less disruptive than maybe first thought. So, Mina, let's start with taxation of family trusts. So, family discretionary trusts doesn't include unit trusts. Of course, the government's been talking about changing taxation of trusts really since I started my career many decades ago. So, it's always been something on the cards. And I think the taxation of trust is probably the one that's less likely to be enacted into law as proposed, but let's see. Anyway, mate, let's talk about how it's going to impact most self-employed individuals.
So sure, I probably just want to start off with saying what we're telling our clients is let's not jump at shadows. It's really important to understand that none of what's being proposed is actually law yet. There's a whole process that needs to go through in terms of it being approved through Senate. The law needs to be written and so forth before it's actually approved. Now, the way that it's currently proposed, it really, from my opinion, just affects sort of smaller, I'll call them mum and dad businesses that potentially earn less than $400,000. Now, if you're a mum and dad business, for example, that earns less than $400,000 and you're in a trust, you're paying less than 30% tax. Now, with the introduction of this law as it stands, then you're going to be paying more than 30%. So it's not ideal. Whereas the higher income earners, the people who have trusts that earn or are able to distribute to sort of beneficiaries who are at 200 grand or more, then it doesn't really affect you because you're really paying that 30% tax anyway. So that's the real key threshold here. So from my opinion, what's really going to change, or what might change from trust law, is the ability to distribute to people that not are necessarily immediately involved in the business. So think about people like your self-funded parents, self-funded retiree parents that you might be utilizing, or adult children. So these are the ones that can really sort of be affected by these proposed changes. But saying that, there was always Section 100A around, and there was a lot of media around this. I think it was 2 or 3 years ago, where the government said we're really going to police this Section 100A, and it actually wasn't a new law. It's a law that's always been around since the inception of trust law that prevents these types of distributions. However, I think it's going to be more so enforced and structured now as part of these revised proposals.
It also means that people need to think more carefully about profit distribution strategies as well, Mina. Like in terms of how much taxable income they want to withdraw from their trading and investment group, and how much to leave in terms of investing and what entities to do that in. So there's going to be apparently an ability to restructure entities to try and accommodate, some of these changes. And really how we used to structure businesses is you'd have a trading company owned by family trust, and underneath the family trust you'd have a corporate beneficiary, sometimes called a bucket company. And so essentially the profit would come out of the trading entity through the family trust, some would go to individuals, and then leftover money would go into this corporate beneficiary to invest. Well, if we're able to restructure without crystallising capital gains tax or those sorts of consequences, and potentially stamp duty in some states, well then what we would do is we would move the corporate beneficiary or the bucket company in between the trading trading company and the family trust. And so in that situation, what would happen is the profit would come out of the trading entity into your bucket company, and then you could decide how much you want to leave in the bucket company. You're going to pay 30% tax, that's all good. And then any money that then comes out of the bucket company can then go into the family trust and be distributed to individuals. So that's still going to achieve pretty much the same outcomes as the original structure. So again, as Mena said, if you already have a substantial amount of profit that you're distributing, so your personal taxable income is 200,000 or more, and you have not been distributing to parents or adult children, and you're potentially able to restructure, then these changes aren't really going to affect you at all. But Mena, in a situation where our profit isn't that high, there's another way that we can kind of preserve profit.
So what you could do is, say you're under this 30% tax rate, you don't want the profits to be retained in the trust or for you to be paying that 30% rate. So what you could do is basically just distribute those profits into a company and let it sit there until you've actually got $200,000 of income to actually distribute. Now, what that does is sort of delays the ability and gives you the flexibility to utilize that 30% credit that you would otherwise have gotten from the trust. And it also allows you to also put a loan in place. So even if you do need to use those funds personally, you can put a complying Division 7A agreement in place for the short term until you're able to retain those profits and work up to a $200,000 and pay those funds out. Now, we're not recommending this strategy right now. Obviously, we don't know what the proposed changes and what would actually come about of it. We're just trying to sort of highlight what can actually work should these proposals actually go through.
Spot on, Mena, and that's why we're recording today's podcast episode. I think once you sort of work it through and help people work it through, you can sort of help them see that actually it's not going to change very much. It's not going to change the amount of tax people will pay very much, except for distributing outside of your family group, so to adult children or retiree parents, these sorts of things. But that was already being taxed through Section 100A. It's not necessarily just because of these changes. So I think the taxation of trust isn't ideal, but I think for most clients and most businesses and situations, there's going to be ways to navigate it that minimizes its impact. Okay, the second one, and probably the most problematic one, is the change to capital gains tax. So obviously we've spoken about that in the Investopoly podcast, and Mena and I did the YouTube live event where we spoke about how, and everyone will be aware now because there's been so much media about it, but post 1 July 27, the 50% discount disappears and you have to index your cost base. It means that assets have to be revalued, including businesses, as the law stands. You don't have to revalue your business, but it would make sense as it approaches and as this becomes legislation. We'll certainly be discussing this more in this podcast. But you'd revalue your business so you can draw a line in the sand. And then post that period, any change in business value is just measured against an index cost base, which is really the business value at 1 July 27 adjusted for inflation. And you'll pay at least 30% tax, a minimum rate of 30% tax on that gain. And this has been attacked, by lots of sectors of the economy. Of course, it's kind of a bit anti-entrepreneurial. And obviously, small business is the engine of the economic engine of the country. And we want to really incentivize people to start small businesses because they can be entrepreneurial and add to innovation and productivity within any country. And so it's good. So obviously having such a high rate of CGT, and by global standards, a very high rate of CGT isn't ideal. Anyway, let's talk about ways that we can navigate this. And I guess, Mena, the small business CGT concessions become even more attractive.
Yeah, definitely, sure. And to be honest, I was a bit surprised that they changed the CGT law and didn't even actually touch the small business CGT concessions. Not that I'm complaining, by the way, but I was just quite surprised about it. But the small business CGT concessions are, if you qualify, can be quite advantageous. And it's really important, and we've spoken about this previously in the podcast, it's really important to sort of get ready for exit well and truly before you actually want to exit. So at least 2 to 3 years beforehand. And then the assessment is around how can you actually utilize utilize the small business CGT concessions to your benefit. Now, there's two limbs to this test. It's either that your business turns over less than $2 million or that there's a $6 million net asset value test. Now, the net asset value test excludes personal use assets. So sometimes, hypothetically, if you're coming to look at selling your business and you're on the cusp of actually breaking this $6 million test, you could potentially upgrade your family home because that's one of the assets that actually fall outside that pool. So these concessions can work really well in your favor and could eliminate all the tax associated with your capital gain from selling your business. So what I would really be doing is, should these laws go ahead, is ask yourself the question as what you could be doing, or asking your holistic accountant, that is, what could you be doing to get ahead of a potential exit of your business? Should it be things such as upgrading the family home or putting money into super or whatever it is? We're not saying that's the solution, by the way, but there's different avenues that you could actually explore to make sure that you qualify for the small business CGT concessions.
The other thing to think about is when we sell a business, typically we sell the assets, not the entity. So for instance, if we have a trading company, quite often buyer of a business doesn't want to buy the shares in the trading company. What they just want to do is buy the assets, the goodwill, the client list, the staff, the processes, all those sorts of things. So in actuality, particularly if you've got a company, the changes to CGT won't actually impact you because the company never received a 50% discount anyway, and any gain will just be taxed at 30%. And then potentially you can then use that past trading company, obviously it'll cease trading, as a investment entity and almost like a third super fund, if you like. And then once you're retired, just pay dividends out over a long period of time to sort of spread that tax burden. So again, it's another sort of situation where you start to unpack it. Again, on the face of it, doesn't look great. But when you start to unpack it, I'm not trying to sell these changes, by the way. They will adversely affect some people. But I think for a lot of people, it's not really going to move the dial that much. Although, as I said at the beginning, having such high rates of capital gains tax is nonsense. The third element to the changes was the quarantining of negative gearing to assets that were held on budget night, held or owned or under contract to sale on budget night. And then after 1 July 27, any properties that were purchased after budget night, existing established properties purchased after budget night, no longer get negative gearing benefits. And look, we've spoken about this a lot over the last few weeks, but it really does move the dial in terms of whether it is attractive to borrow to invest in established property. Now, of course, negative gearing is allowable on new property that didn't exist. So whether you demolish a property and build 2 townhouses, for example, you can get the negative gearing on something like that, or buying a house and land package. Mena, perhaps you might want to talk about, small scale developments and what we see in our client base.
Yeah, it's a bit hit and miss with the small scale development, sure. We see a lot of it here where there's a lot of buyers agents that push for these properties, say in a sort of around the Bayside areas, particular around sort of the likes of, sorry, I'm referring to Victoria here. So it's a bit subjective, but what we typically find is that the dual occupancy, the 2-unit developments are very hard to make work, okay? Because you're only splitting it into 2 dwellings. You're not really getting the economies of scale on that piece of land, and you're building a product that commands a much higher sort of value on resale. So typically, I'm not going to say it's always the case, and sometimes when there's an owner-occupier play, it works well, but typically those dual occupancy plays are very difficult to make work unless you've really held the property for a long period of time and sort of enjoyed the capital growth along the way and the underlying land value. The multi-unit development, so think about 4 plus, they typically can work well, but it's really important to get the advice first. Get independent advice. With respect, buyers agents in this arena aren't exactly well versed in development, and they'll sell you a dream of you being a millionaire overnight, and we've seen these things go wrong very quickly. So it's really important to engage a holistic accountant that has experience with these types of developments and can run some feasibility analysis for you before you engage or undergo any sort type of development.
That's excellent advice, Mena. So same with new build properties, by the way, in terms of it not necessarily necessarily being an attractive investment. And I'm sort of talking about things like house and land packages that, I mean, these tend to be on the fringe of cities. So they're located in an area where land supply is abundant. And I also question, whether the tax benefits that will be unique to the first owner, to what extent will they be reflected in the purchase price as well? So I think if the rules stand, the investing in established residential property just doesn't stack up anymore without the negative gearing benefit. Could pivot and do a small scale development, but as Mena said, make sure you get your holistic accountant that has experience in these sorts of developments run the ruler over it to make sure that actually it's a productive use of your capital, that you're going to earn a decent return for the risk, and steer clear of those sort of new build house and land package style property developments. Of course, you could gear into the share market, so that'll still give you some negative gearing benefits, but it's going to really depend on your personal situation, of course. But hopefully, your holistic accountant can help you navigate that. The final observation I would share is that tax rules change all the time. And I guess, after 1 July 27, there's no negative gearing on established property. That was purchased after budget night. But if we expect a change of government, because there'll be a federal election in mid-28, if there's strong indications that there'll be a change of government in 2028 and that new government is likely to reinstate negative gearing, then there could be some good buying opportunities over the next couple of years. I'm not suggesting that people should do that, but if you form the opinion that negative gearing banning will be temporary, then there still could be opportunities available. I guess what we want to do today really is talk through those changes, and look, they're going to impact some people adversely, and that's going to be material. But for many people, I think these changes will be able to navigate around these changes and minimize the impact so it doesn't really derail to a large extent any individual plans. But I wouldn't make any changes now, as we've said a number of times today. It's all still proposed, but rest assured, we certainly are at Pro Solution all over it and thinking about ways that we can help clients navigate it. And when the time comes, which is not now, we'll certainly be having those conversations. And for those listeners with other accountants, I'm sure they're doing exactly the same. Okay, we'll leave it there for today. Until next week, bye for now.